Thin capitalization rules, also known as thin capitalization regulations, are tax rules implemented by many countries to prevent multinational corporations from using excessive debt financing to minimize their tax liabilities. These rules are designed to ensure that a company's capital structure, particularly the ratio of debt to equity, is not manipulated in a way that reduces its tax liability in the host country. The term thin capitalization refers to a situation where a company is deemed to be thinly capitalized, meaning that it has an inadequate amount of equity capital compared to the level of debt it has incurred. When a company is thinly capitalized, it may be able to deduct interest expenses on the excessive debt from its taxable income, resulting in lower tax payments in the host country. Thin capitalization rules typically set a threshold for the debt-to-equity ratio, and if a company exceeds this threshold, the interest expense deductions on the excessive debt are disallowed for tax purposes. The specific rules and thresholds can vary from one country to another, and they may also depend on the nature of the business or the industry in which the company operates. These rules are in place to prevent profit shifting and base erosion, which is when multinational corporations exploit differences in tax rates and rules between countries to minimize their global tax liability. By limiting excessive debt financing, host countries can ensure that companies pay their fair share of taxes within their borders. It's essential to consult the tax regulations of the specific country in question to understand the exact requirements and thresholds for thin capitalization rules, as they can vary significantly from one jurisdiction to another. Additionally, companies often work with tax professionals and accountants to ensure compliance with these rules while optimizing their capital structure for tax efficiency.